What a crazy day and what a wild week so far. 34 felonies, 2 impeachments, and 2 assassinations later, we finally have our president. This election will truly go down in history because history is written by the winners. But the question now is, what will be the winning trades over the course of the next 4 years, and where do we go for the rest of the year? That is what we're here to talk about today, so let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks surged to record highs on Wednesday as investors digested Donald Trump's win of the presidential election over Kamala Harris. Stocks rallied in anticipation of robust earnings growth through tax cuts, easier regulation policy, and stronger domestic policy. A bunch of analysts reiterated a whole bunch of price targets over the next 12 months for the S&P 500. Goldman Sachs said 6,300. I saw some analysts say 6,500. So things are looking bullish. And what we really saw today was the Trump pump, or more formally known as the reflation trade. And the biggest winners here, definitely financial, specifically banks, JP Morgan, Bank of America, Wells Fargo, all up double digits. Very, very strong returns, but technology also participated. Nvidia, semis, software, Microsoft, Amazon, Tesla was up 14%. We saw outperformance in the broader market, and where we saw underperformance today was defensives and rate sensitive sectors. And it is official. Trump will be in the White House. He will be the 47th president of the United States, and he won almost every key battleground state, but specifically Pennsylvania, Iowa, and North Carolina. Trump has garnered 292 electoral college votes. He'll be in the White House in the middle of January, and this was made official early in Wednesday morning after the state of Wisconsin was called for Trump. So he is the 47th president, or will be the 47th president of the United States. But outside of the presidential election, Republicans also flipped the Senate. They gained 3 additional seats. Democrats lost 3 seats, and it looks like the House might flip Rhino as well, but control of the House of Representatives remains unclear and likely will for a couple of days. So it looks like Republicans are going to have control of the House, the executive branch, and the Senate, and that means Trump will be able to push through a lot of policies and really enact change according to his will. Now, looking at the overall market, guys, we really saw outperformance in financials as well as the Russell 2000, the RTY. Both were up in excess of 5.5%, and the reason why the RTY rallied actually had to do with regional banks. About 30% of the RTY is regional banks, and what we really saw was a new era of regulation. Pretty much Trump victory means looser regulation for banks and more leniency in approving these sort of corporate mergers that produce big profits for Wall Street. The S&P 500 today was up 2.5%, and we saw rallies in everything: technology, discretionary, energy, industrials, communication services, and materials. Where we saw underperformance though was defensive sectors as well as rate sensitive real estate. XLRE was down 2.64%, and we saw stark underperformance in staples, utilities, as well as healthcare. And pretty much why we saw that is Trump's policies is expected to lead to more unpredictable mortgage rates. We're going to see structurally higher yields under Trump victory just because he's going to spend more. And while higher yields do reflect a stronger economic backdrop, it also means a higher cost of capital, and rate-sensitive industries will suffer in the near term. But looking at today, guys, we saw rallies in every size segment, every factor segment. Small cap value performing the best, up 5.17%. But when every single segment is producing returns in excess of 2%, it doesn't really matter. If you were positioned in equities, broad indices today, the S&P 500, the Russell 2000, you really did well, and I do think that's going to continue. But let's actually look at some of the earnings reports we got today. Celsius dropped earnings. They were down 7% in a very green day of trade, and that's because they missed EPS estimates. They reported $0 in earnings. The market expected them to report 3 cents. They missed on revenue, a softer guide. All in all, if it wasn't for the reflation trade we saw today, I think the stock would be down like 10, 11, 12%. I do think we'd probably go to $25 before the end of the year for Celsius. Very ugly earnings. We also saw ugly earnings in Novo Nordisk. Now, their guide was actually very soft. Their earnings were good. They beat on revenue, beat on EPS. Their guide was soft, and that's because stuff like these compound GLP-1 pharmacies are taking share from them. The market didn't like that. However, what the market did like was stuff like Tesla, up 14%, and this was pretty much on the back of easier regulation in the auto industry, international tariffs on international auto producers, as well as more rebates. And Tesla probably is going to go to 300. The stock's going to rally into the end of the year, and I think the Q4 rally officially started today. Yeah, we might base around for a couple of weeks, digest all of these gains, but then it's onward and upward. And Trump's election win is officially shifting how economists are viewing the path forward for the Fed funds. Now, Trump's main campaign promises is a new wave of tariffs and mass deportation of undocumented immigrants, and that could put upward pressure on prices, and the market is reacting accordingly. Markets have now moved from seeing nearly 8 cuts when the Fed first cut back in September to now pricing in about 4 cuts through the end of the year. However, the big thing is we are moving lower in the Fed funds, and that should mean a lower cost of capital in general, particularly when the Fed funds gets to this 3.5% mark, which we should see mid to late next year. I think structurally yields should move lower. However, the longer end can be a bit stubborn. One thing we also saw today was China. China stocks and Asian stocks tumbled on the back of a Trump win, and as China goes, so too does Europe. But for the rest of the world, globally, things looked largely positive in North America, not so much in South America, but after yesterday's positive day, I think we saw a bit of profit taking. And then Australia, pretty green, but all in all, a terrible day for China, especially China stocks. Baba, PDD, JD, they were all down in excess of 3 and 4%. But looking at market breadth, guys, market breadth was strong yesterday, and we actually improved across the board. Particularly look at the 150-day and 200-day moving averages. This is percentage of stocks above their individual moving average, right? And you can see from 59% to 64% and 58% to 63%, we saw a huge structurally higher move in the longer term moving averages. And this probably tells us that you actually want to buy this move we're seeing. We're probably going to see more momentum to the upside. I think this move is going to dissipate closer to the 61, 6200 area. Yes, we may base around. So we had a huge move up. We may just consolidate, and then we're going to make the next move higher towards the end of November, start of December. But we'll see how everything plays out. But today we had strong market breadth in the shorter term, medium term, and longer term averages. And that tells us the trend is intact. And let's actually hop on the charts. And the S&P 500 officially gapped up and rallied to new all-time highs today at 59.29. At the same time, we also saw the advanced decline line hit a new all-time high. So the all-time highs we saw today was confirmed by the all-time high in the ADL line. And today's rally was a blockbuster rally. Very strong returns. The gamma flip moved up to 58.65. We are in positive gamma as well, so do expect the trend to continue, but not without a little bit of digestion and consolidation. This was a huge move up in equities. Do expect a little bit of consolidation, guys, and then a move higher, but the trend is clearly higher, and 6,000 is our target towards the end of November, start of December, and then we can start talking about levels above the 6,000 area for the S&P 500. But things on the year-to-date chart look really, really strong. But let's actually look at what the markets did as a whole. The S&P 500 up 2.53%, the NASDAQ 100 up 2.74%. Very, very strong days. This is market-based indices, and the underlying assets are moving much, much more. The IWM up 5.79%, and we are seeing some mixed reaction here in the after hours. In fact, I wouldn't say mixed. The RSP is actually flat in the after hours, and we're seeing good momentum in the SPY and the Qs in the after hours. The IWM giving some back, but to be honest, after a 5% rally, you actually want to see a little bit of profit taking. That's healthy market momentum. Now, the equal weight was up 2.3%, equal to what the S&P 500 did or thereabouts. Mid caps up 4%, and the SP 600 profitable small caps up 6% for the day. Absolutely crazy. Now, we did see huge momentum in yields. The 2-year yield, 10-year yield, and 30-year yield were up 2 to 4% on the day. The dollar gained 1.64%, and that has to do with Trump's domestic policy. And pretty much you're going to see a bigger deficit under Trump, and the market is pricing that in. But on the flip side, that bodes well for a stronger economy. Bonds were a dumpster fire, down 0.78 and 2.74% for the TLT. That's like a 1 sigma move. It's kind of crazy to see that, but we're seeing a little bit of respite here in the after hours. And then scrolling down to commodities, a dumpster fire for commodities, except Bitcoin, which was up 9,000. Let's quickly have a look. That's a new all-time high on the monthly, weekly, I believe, as well as daily charts here for Bitcoin. Very, very strong momentum. However, if we look at gold, commodities as a whole were down a lot, down 3%, 4.56%, and crude was largely flat. And this has to just do with the dollar and yield dynamics. When bonds are paying more in a yield and expected to pay more structurally, and the dollar is stronger, you're going to see a flight out of commodities into yielding assets. And those assets are simply just bonds, right? As well as the dollar. So commodities will take it on a chin, but I think with the structurally higher deficit we'll see from a Trump campaign, I think this pullback we see in gold, use it as an opportunity to get in. I still believe in 3,000 gold in the first or second quarter of 2025, as well as $45 to $50 silver. But let's actually look at the S&P 500 more in depth. And guys, we are in positive gamma, right? And I think our target right now is 6,000 towards the end of November. We have a little bit of consolidation, maybe even a pullback to this 58.65 area, and then we'll continue to move higher. And this looks very, very good. I mean, we put a low right here, higher low, another low. We did see a bit of a daily downtrend into the election. That has to do with the pre-election volatility we see, but we managed to stay above this low right here, put in a higher low, and now a gap up and move higher. A little bit of pullback, expect a higher low, and then we should continue the move to the 6,000 gamma call resistance. Now let's have a look at the Nasdaq. This is absolutely crazy. We pull up this chart, you can't even see the gamma flip, right? The Nasdaq 100 hit a new all-time high, and I don't know if this is a mistake on my data or if this is actually the case, but I'm just reporting the facts as to my data. And if we actually look at where the core resistance is positioned, 22,000, 10% above the current closing price of the Nasdaq 100. We'll see what this looks like tomorrow, but we saw a huge move. Maybe it's a data anomaly. Maybe the options market is extremely bullish on the Nasdaq 100 index, but a new all-time high. I said we would get there. I said that right here. I said that right here. And I said that throughout the rally, we will see new all-time highs in the Nasdaq 100 before the end of the year. And this is where we are. Now, the core resistance is at 20,560. It puts support at 2235. We're at new all-time highs. It's very, very bullish. Look at this year-to-date chart. Yeah, we had quite a bit of volatility here in the last 2 to 3 months, but that's a new all-time closing high for the Nasdaq 100, and the core resistance 22,000. That is absolutely crazy. We'll see if this moves down tomorrow, but the options market is apparently extremely bullish on technology stocks, and the Nasdaq 100 doesn't even include financials, so it's very weird to see this type of price action. And then look at the RTY. That's a very, very strong move. I've said for weeks and weeks now, this price action in the RTY that we're seeing, right, these higher highs, higher lows, despite yields also rising in this time period, goes to show the strength and relative outperformance here in the Russell 2000. And if we actually go on the weekly chart and zoom out, right, let's actually reset this chart. Guys, this is all-time highs right here. If we actually just take a measured move, let's go on the monthly chart just to zoom in. And if we go from the close of today, right there at the 2393 area to the top of this week, we're looking at 2.94%, and we hit all-time highs in the Russell 2000. Let's go on the daily chart. That is absolutely insane to see how close we are to new all-time highs. And like the Nasdaq 100, like the S&P 500, we are officially in positive gamma for the Russell 2000, and there's plenty of upside. In fact, the 2500 area is above the new all-time high for the Russell 2000. Do expect, like the S&P 500, a bit of consolidation, maybe a move down. We are seeing that in the after hours, and then a strong move back up to all-time highs. I think we take out all-time highs in the Russell 2000 before the end of November. I do see that as a possibility, but we do have to look at the risks in this market. This is a higher cost of capital we're seeing in the rates complex. index as well as the dollar, and we want to see how that affects the overall small cap market, because they are rate sensitive, and eventually these yields will come back to bite these companies as the cost of capital increases. And that's why I've always championed stuff like the CARF index. Essentially, you're getting the same volatility you would in small caps with the reliability and quality of stocks like the S&P 500. And you can actually see this was up 6.02% today, outperforming the IWM and outperforming the S&P 600. So small cap cash cows, huge move. If you are looking to get into small caps, this is what I would recommend, as well as XSHQ, the small cap quality ETF. It was up 6.53% today, and that's a new all-time high, I believe, in these small cap quality indices. And guys, let's just quickly look at the charts of gold. You see a huge pullback right here, but I remain structurally bullish as long as we're above this 2600 area. So if we see some consolidation here, a little bit of pullback, and then we consolidate, we can then move higher and go from there. I'm still bullish on commodities. All of the price action we're seeing in yields and the dollar is telling us we are going to have structurally higher inflation as well as a higher deficit, and gold is simply a hedge against that. Very similar price action in silver. We should see a little bit of consolidation and then a move higher, but that consolidation could take anywhere from 2 to 3 weeks. And then looking at the RSP, that's an all-time high close for the RSP, by the way. Very, very strong move. And we were talking about this, right? We said the two areas where you want to be buyers is right here, the 176, and if we break this, we want to be buyers here at the 172 and 170 area. We did not break the 170, 172 area, and that means this was the place to buy. A new all-time high, things looking very, very strong, and I do think we see a 200 RSP sometime in 2025. Plenty of upside for these names, plenty of upside in the market. Guys, do expect a little bit of consolidation. I'm not saying we're going to fall apart, but a little bit of consolidation that may be upside tomorrow, a little bit of downside, but just expect a little bit of volatility in these markets through the middle of November, and then we should continue to move up to the 6,000 level in the S&P 500. So for those of you that are positioned, let's reap these rewards, keep holding, we will go higher. Buy the dip, guys, don't trip. And this is CNN's Fear and Greed Index, a gauge of sentiment we've used consistently on this channel, especially this week. And even after yesterday's rally and the price action we saw today, the market is still in fear. Fear is driving the US market, and that probably has to do with the FOMC. The election is largely behind us, but there is still that fear as to what the Fed could say for the rest of the year when it comes to rate cuts, as well as 2025. So yes, there is still a little bit of angst in the market, but I think after the FOMC, after the rate decision, we should be all good to go. And I think then the market can pivot back into the greed, neutral, and maybe even extreme greed territory. We are set up really, really well for sentiment to move in the right direction. But we first have to get through the next couple of volatile days and weeks. If we look at S&P 500 implied moves, we actually see some very glaring things. Almost every single day in November for the next couple of weeks, excluding Friday of next week, is actually above the 3-month realized volatility, meaning that we could see elevated volatility to the upside and downside going into these days, going into the end of the year. And this is all going to depend on what comes after the election and what the Fed has to say, as well as earnings revisions, yields, the dollar, as well as everything else. So we are in a heightened time of volatility, and that's why over the next couple of weeks, guys, take any opportunities you can to buy the dip. And as crazy as this year's been, it also has to do with inflows being highly irregular. Equity inflows have been exceptionally strong for an election year. This is in sharp contrast to prior election years where we actually saw pretty much flat to down inflows, and then after the election we saw market positioning on the bull side, and then after the election we saw massive bullish positioning. In 2024 we've seen very bullish positioning from the get-go, and I do think this probably continues. Historically speaking, this is what normally happens. And looking at November seasonality, yes, November is a bullish month, but it only really comes after the 13th, 14th and 15th of the month. Normally, we actually trade slightly up to flat in the first part of November. We actually then trade down a couple of days into the 15th and 16th of November, and then we find a bottom and actually have a blockbuster rally into the end of November, breaking the highs we made in the middle of the month and actually finishing November normally at the highs of the month. So if we do get volatility, we want to take those opportunities to buy the dip, guys. But let's switch gears, actually talk about earnings, where we are and where we're going. Now, Q3 2024 blended earnings growth looking very solid in my opinion. We could see earnings at 7.8% growth for this quarter, 5.1% revenue growth. We are smashing analyst expectations, and things look even better if you exclude the energy sector. Margins also printing very strong, and we've had about 80% of S&P 500 companies report. 380 companies have reported, 75% reported above analyst expectations, and the long-term average beat rate is 66.9. So we're having a fantastic earnings season, and the average stock has moved about 5% on the day after earnings, representing the second largest move in history, and this quarter was the highest at 5.2%. Companies that have beat have been rewarded this earnings season. Companies that miss have been punished, but not as much as the average in the last 20 years. However, there are still risks this earnings season, with 80% of the S&P 500 having reported for the quarter. While the surprise and beat ratios are decent, earnings guidance and revisions are running at their worst levels in over a year. We've seen fourth quarter earnings being revised down negative 1.8%. We saw a very similar move here in the third quarter, and although this does set us up for a good beat going into the fourth quarter, we do have to ask the question, why is that? And a lot of it just has to do with spending, inflation, rates, yields, the cost of capital, and we'll see how that pans out. But as it is right now, we are seeing very clear fourth quarter earnings revisions, and I do expect this to increase ever so slightly as we head into the fourth quarter earnings season. But that's neither here nor there. Let's first focus on the third quarter right now. We still have a couple of weeks of very big earnings ahead of us, and let's get through that first, and then we can focus on the fourth quarter. And diving into the macro, let's look at the economy, guys. We got Goldman Sachs fourth quarter tracking estimate, and they launched their GDP estimate at 2.6%. And guys, we've seen very robust economic growth this year and for the last couple of years. And economic growth has actually remained robust despite a 500 basis point move in the Fed funds, or the cost of capital, from the COVID lows. And this move has largely not affected stocks, companies, and the private sector. Companies have really just brushed off the higher cost of capital, and Goldman believe the decline in yield to debt sensitivity can be in part explained by the rise in private sector savings. Corporate cash holdings as a percentage of GDP have risen substantially over the last few decades, and when the Fed went on their hiking cycle, it did cause near-term volatility, but stocks and companies largely brushed it off, and that's because their balance sheets are sound. Companies have huge amounts of cash, and US corporate balance sheets show interest burden at historic lows. And simply put, guys, this is why you invest in high quality businesses, because they can weather any storm. And if you actually have a look from the COVID highs as well as the GFC highs, interest burden has come down in a very big way. This just means that companies are making more cash, they hold less debt, and their balance sheets are far more superior than what they were in any other time in history. Looking at earnings for the rest of the week, guys, tomorrow, Thursday, we have Vistra Energy, Moderna, Barrick Gold, Datadog, Halliburton. Those are the big names. Hershey too, a lot of dividend growth investors like Hershey. Then after the close, we have DraftKings, Arista Networks, Rivian, The Trade Desk, Affirm, Fortinet, Pinterest, Airbnb. A lot of big names on Thursday reporting. So it's going to be a very volatile day on Thursday, and it's only going to get more volatile because tomorrow, Thursday, we have the Fed's interest rate decision, FOMC, as well as the Fed's press conference. We also have non-farm productivity, initial jobless claims, and the unit labor cost index. So that's all coming tomorrow. Now, the Fed's rate decision, the consensus is actually for a 25 basis point cut. So all eyes are going to be on that. And then Friday, we have Michigan. And then on Friday, we have UMich sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.